And we're live.
Welcome back to the Transformational CFO, a podcast from WilliamsMarston's where we explore insights, stories, and strategies from the financial leaders shaping the future. I'm Guy Wanger, sitting in today for our regular hosts, John Marston and Landon Williams. I lead the advisory practice in the West region, and I'm thrilled to be guest hosting this special conversation with one of the most influential voices in financial reporting, Jim Kroeker, who also happens to be on WilliamsMarston's Strategic Advisory Board. By way of introduction, I want to share a little bit about Jim's background. Jim spent the past decade as vice chair of the FASB and previously served as chief accountant of the SEC and as the deputy managing partner at Deloitte. His career spanned policy setting, standard setting, and practice leadership, all focused on making financial reporting more transparent and effective. His regulatory perspective is unsurpassed, and his insights are invaluable to the challenges many business leaders are facing today. This episode was recorded prior to the U.S. Securities and Exchange Commission's remarks made in September 2025. As such, any commentary or discussion in this episode does not reflect or incorporate those developments. Please keep this context in mind while listening. Welcome to the show, Jim.
Thank you.
So, Jim, let's get started by talking a little bit about your career. You've had a front row seat to transformative chapters in finance and policy. Can you take us back to the early days of your career? What were some defining moments that shaped your view of what finance can and should be?
Certainly, and it's a pleasure to join this podcast series. Maybe just start by a little bit of my background. I started with one of the large accounting firms, now a Big Four firm in Omaha, Nebraska. And like many who started in the profession, had the opportunity to be mentored by a number of just high-standing, high-caliber individuals who understood the purpose of accounting and the purpose of auditing and sort of that relationship between the outside investor, stakeholder, and management. So that the role of accounting and the role of auditing, and really instilled that in me. I think back to one of my closest mentors, or somebody who I've really appreciated as a mentor. And one of the phrases that he used that stuck with me is accounting is the language of business. And it really, comes back to that for me through my career. And I think of several inflection points where, providing that language of accounting in a way that's understandable by users of financial statements really has stayed the test of time for me. And I'll give you just maybe a couple examples. I think back in the late 90s in the internet era, sort of the tech bubble, where you saw accounting that wasn't being used as a great tool for investors, whether that be through off-balance sheet structures where you had tremendous risk that was not being portrayed accurately in financial statements, or things as basic as revenue recognition, where there weren't clear rules on something as fundamental as buying a good or service through the internet. Let's say the stated price was 100, but you could get a app purchase coupon that reduced that price to say $20, and recognizing $100 of revenue and $80 of marketing expense for a transaction that was fundamentally a sale at $20. It showed me sort of the harm that can be done to the market and to society really at large when you have those broader failings. Just think about the devastating effects of a buildup in capital and then a subsequent collapse. And so that stuck with me, sort of going back to, again, my earliest days, is accounting as the language of business. And then sort of the trust that gets instilled when that's done well. We have a tremendous society because of that transactional nature of investors being able to rely on financial statements and things that go terribly wrong when they can't. So really, that's one of the things that stuck with me throughout my career. And then growing up in the Midwest, and maybe it's a Midwest thing, or maybe Midwesterners like to think it's a Midwest value, but really that sort of plain spoken aspect of financial reporting is something that I have a passion for as well. I think some areas of accounting and financial reporting, we do that well. Other areas we don't do so well. So I still have a passion for simplifying accounting and making it not just the language of business, but a language one can understand. And maybe just something quick there. There's nothing like having to explain to the chair of the SEC in a financial crisis why a company has a prosperous or successful quarter because it's marking to market its own debt. So taking gains in the value of its own debt as an entity becomes less and less prosperous or nearer and nearer to bankruptcy. So the value of its debt is going down and it's reporting gains. So it's that counterintuitive aspect of accounting it's really stuck with me as well, is that accounting ought to be a language not just understood by accountants, but understood by the marketplace in general. And so when the SEC chair is challenging you on the usefulness of financial reporting, perhaps you have a problem. So those are just maybe some of the things that have shaped my passion for financial reporting. Why I'm continue to think that there's we do a really good job in financial reporting in some areas, but I think we have a ways to go in others.
Great stuff. I know I'm a big fan of plain English and being able to communicate to anybody what the financials are trying to say. Next, why don't we move on to the regulatory and policy landscape, something all company leaders are grappling with today. So what's the current tone and posture at the SEC under the new administration?
Yeah, good question. Chair Adkins, who took over earlier this year, has said on a number of occasions that it's a new day at the SEC. And if you listen to his remarks, I've seen 3 or 4 speeches where he started with that as part of his remarks, that it's a new day at the SEC. I think he's doing that as both a, practical signal as well as just a more pragmatic turn from the SEC of the last 3 or 4 years to talk about his vision of what the SEC ought to be focused on. And I'd say maybe 2 or 3 things come to mind for me when I hear that. One, I would say it's a move back to the more traditional view of the SEC's 3-part mandate: protecting investors, fair and orderly markets, and capital formation. So I would say, maybe signaling a more strict adherence to that 3-part mission, at least, I think from his perspective. And I would say, another thing that comes to mind for me is perhaps more engagement with stakeholders, with market participants, and greater regulatory clarity. And then finally, I would say refocusing on that 3rd part of the mission, the capital formation part of that mission. I think, at least in some perspectives, there's been more of a focus on the rulemaking side or perhaps the enforcement side with less focus on the capital formation front. So I'd say those are probably the 3 things, at least when I hear the tone at the SEC and what I think we could expect. Those are what come top of mind for me.
I appreciate that perspective. Chair Atkins' emphasis on it being a new day at the SEC certainly suggests a meaningful shift in regulatory philosophy. I think a lot of people would love to see more capital formation activity. What sense do you have of the SEC's enforcement and regulatory priorities today?
Yeah, I would say I'll start with the enforcement front. And I would say, on the enforcement front, it would probably be prioritizing cases of clear investor harm, clear fraud, as opposed to maybe more novel or, cases in a less traditional area. Some have talked about cases that established effectively rulemaking through enforcement, maybe going on in the last 3 or 4 years. I think under the current SEC, we should expect perhaps cases where they prioritize, more demonstrable harm to particularly individual investors, things like market manipulation, insider trading, offering fraud, that type of thing. And I think accounting fraud, just from my perspective, would be front and center on the enforcement front. The other area that, Chair Atkins, I know in the past has been passionate about is holding individuals accountable, not just looking at whether or not there is the ability to get a corporate fine or penalty, but actually holding the individuals that are responsible for the activity accountable on coming back as chair. talked about those who lie, cheat, and steal are going to be held accountable by the SEC. Certainly, that would be kind of where I'm at, or where I would think they would be at on the enforcement front. And I say more broadly on the regulatory agenda, I do think it is going to be focused on embracing innovation, embracing transformation, whether that's in the crypto space. We've seen the formation of a crypto task force. I think some might contrast that to the past SEC, where it was less willing, in some people's view, to embrace, less traditional forms of finance through crypto. Um, talked a little bit about the rulemaking through enforcement. I think setting out clear expectations, embracing that new technology, and then finding a regulatory regime where crypto does intersect with the securities law, where that regime is fit for purpose. That is, the rules that govern crypto, whether it's registration or whether it's ongoing reporting, fit the nature of the transaction that's being engaged in. So I think establishing those clear rules will be a priority as well. And then maybe one other that comes to mind, at least for me in the accounting space or the financial reporting space, is maybe a more traditional focus on materiality. Is information that the SEC is pursuing likely to be, would it be used by the reasonable investor in their decision making? And so I think you might see that, if you're responding to a court fin comment letter, that the focus might be more on transactions that are likely to be material. I'll probably see that in their rulemaking as well, right? Uh, the prior SEC and its rulemaking on climate change. Certainly, I think many on the current administration side would question whether or not the reporting that was being asked of corporations there was really material in a traditional sense to a user of those corporate reports. So I'd say, again, maybe a focus on what's likely to be material to somebody who's allocating their capital.
I know that will certainly be welcomed by many, both preparers and users of financials. We're also seeing a shift in how policy is being shaped, increasingly through executive orders rather than traditional legislation. What are your thoughts on the implications of this shift for risk oversight, disclosure, and MD&A?
Yeah, we have seen a lot of activity, certainly in the early stages or early days of the administration, whether that's, trade policy, executive orders on DEI programs, a number of other areas that have also got attention through executive action. And I think it calls for corporations to be very thoughtful in terms of how they discuss or how they want to position themselves relative to those issues. Perhaps a higher level of engagement with senior management, maybe involvement with the board of directors before an entity, takes a view, let's say, on trade policy or how it wants to talk about that, either in investor calls or in its MD&A, or even things like a chief economist of an organization taking a view, not saying to pull punches one way or the other, right? But just making sure that you have a very thoughtful approach to how you want to talk about an issue, whether that's trade policy or diversity, equity, and inclusion, ESG. And so I think just a heightened awareness at all levels of the organization, not just for their actions, but probably their partners, their strategic partners. We can see, not just your individual corporate actions, but actions of those that you're affiliated with. So I think, if you don't already have that on your risk dashboard, it's probably something that organizations ought to be conscious of, and again, taking that informed approach on how they want to deal with things that might garner political attention that may not have in the past.
And I know some companies are even reconsidering whether to raise certain issues at all, opting to tone down or step back from disclosures around certain topics. So with that in mind, let's shift gears and talk about accounting standards. How do you view the current FASB technical agenda and its priorities?
Yeah, so what wonderful question. I was looking the other day, just doing some straightening around my office, I pulled out the last printed version of the FASB codification. It's 4 bound volumes. I didn't count the pages, but it's got to be 4,500 to 5,000 pages of codification instructions. And with that, I would say we pretty much have the watershed covered in terms of transactions and guidance within GAAP that would tell you, how to address nearly any situation. Maybe touch on a few where you can find areas to analogize to, but by and large, we've got it covered. And so I think it's important for the FASB to ask itself, are we being intentional in what we're doing? And I think the FASB, by the way, is doing that. They've opened up an agenda consultation process, asking all stakeholders to provide them insight into what they think the key priorities ought to be. I would say from my perspective, and we talked earlier about just simplicity in language, simplicity in reporting. And I think there's some areas in GAAP where we should challenge ourselves as to whether or not the complexity that we require people to engage in meets that cost benefit trade-off. Goodwill is probably one of those areas. I know that a lot of companies go through complex analyses to determine whether or not their goodwill at various levels is impaired or not impaired. To me, that's by definition a lagging indicator anyway, because goodwill is the result of investors, buyers and sellers placing a market cap on an entity. So it's unlikely, at least in my view, to provide significant, meaningful information to users of financial statements who've already determined that market cap in any other way than on a lagging basis. So perhaps there's an easier way to address goodwill. I personally would like to see us think about amortizing that goodwill. I know that probably a number of our listeners would say, well, people would just disregard that amortization. That may well be true, but I think we could do it in a way that reports earnings pre-goodwill amortization, post-goodwill amortization, and takes some complexity out. So that's just one area. I think there's a handful of others, perhaps on how we deal with purchased intangibles and the difference you see between the accounting for a purchased intangible and an internally developed intangible. One certainly could challenge whether that puts pressure on growth through acquisition or pressure on growth through internal, and whether we have that balance right in financial reporting, even before you get into the cost and complexity of dealing with purchased intangibles. I personally think as a board member at the FASB, you often heard that in an increasingly intangible world that we live in, whether or not we're capturing all of the value that an enterprise generates through financial reporting, and I'll concede that the balance sheet doesn't capture a lot of valuable assets in an intangible-based economy. But I do think that users and investors, capital providers, increasingly in that space then rely on the income statement to derive their value proposition in entities. And so is there a way to take some of that pressure off in the reporting of intangibles? And maybe one final area, and I think this would fit with sort of the capital formation, taking a look at the cost benefit trade-off of being a public company that's likely to be important to the SEC. And that is the volume of disclosure. Maybe the easiest lift is looking at quarterly disclosure first. I go back to when I was first involved in financial reporting, and I'm not suggesting we had the right balance, but a 10Q and a quarterly report are used to be able to be printed in a handful of pages, 15, 20, 30 pages, and we're exponentially larger than that. And if you go back and look at SEC speeches, even in that era, people were challenging whether or not we had a phenomena of disclosure overload. Well, we've certainly taken that and again multiplied that by 2 or 3 or 4x in terms of the volume of disclosure. Obviously, the financials are only one piece of that. It's useful to challenge ourselves in that cost-benefit equation. Are we providing what's material to investors at a reasonable cost? And I'd like to see the FASB take a look at that issue as well.
Preaching to the choir. Very much agree. I think, a really prudent and effective focus. So we're hearing some frustration from companies navigating the pre-clearance processes at the SEC, especially those that are planning IPOs. Do you see any signs this might improve under the current leadership?
Well, let me start with, and I didn't touch on this when we were talking about the SEC and its priorities, but we have seen a number of staff at the SEC resign and take other opportunities. So I think you are going to also see a more streamlined and perhaps efficient SEC in terms of number of employees. I would say from the standpoint of just number of bodies to deal with issues in the office of the chief accountant who deals with the pre-clearance process, that is down a little bit. But I do think there will be an increased focus on resolution of issues timely, of more proactive engagement with whether that's issuers or their auditors. I also think that the SEC will be more open in the coming years to resolving issues through a process like the FASB's Emerging Issues Task Force. In the past, you might have thought this is sufficiently unclear in the literature to me that I want to go through a pre-clearance. Perhaps some of the pressure could be taken off by having the FASB and their Emerging Issues Task Force take a look at some of those issues. I also think that the focus on materiality is likely to govern. And then I think, the SEC's focus on enforcing clear rules and not trying to establish rules either through, enforcement, or I would say in this context, effectively enforcement by mandating a single answer through a pre-clearance or a speech, I think is less likely to occur. We saw that with some staff accounting bulletins under the prior administrations. One of those staff accounting bulletins was rescinded, I think, within days of the change in administration. So I think maybe a little more openness to diversity in practice where the rules aren't clear, with the understanding, again, if that diversity matters to investors, then rules ought to be established through a notice and comment rulemaking process.
That certainly sounds like there could be a shift to being more efficient and collaborative. Are there areas where you see an opportunity for meaningful regulatory relief or modernization, either at the SEC or more broadly?
Yeah, one, we talked about the issue of regulatory relief through, and I don't know if relief is the right word or if it's sort of that cost benefit equation in the disclosure space. Quarterly isn't the only area. Certainly you see fairly long 10Ks where there's a lot of useful information to investors, but you'll also hear from companies, we don't hear a lot of investor questions on our 4 pages or 5 pages of pension disclosure. So I think there's some opportunity there. Although I will say that is a hard lift. Taking away regulation, or in that context, taking away disclosure, is probably in some cases harder to do than adding disclosure. And so I'm hopeful that it can be done, but I'm also cautiously optimistic, knowing what a challenge it is to get done. A couple other areas that come to mind to me. One is in the audit space. So, taking a look at reform of the Public Company Accounting Oversight Board. There were some potential legislative actions relative to the PCOB and the big, beautiful bill that ultimately did not make it through the final bill. But I don't think that that's the end of the road as it relates to where we might head with audit regulation. You've seen the chair of the PCOB resign earlier in July. The SEC announced that it's seeking to replace all 5 members in this instance of the board. And I think certainly not unprecedented. That happened at the beginning of the last administration as well. But I'm hopeful that it also comes with the opportunity to take a look at the activities of the PCOB. I believe that independent oversight of the profession, of the auditing profession, has provided an increase to audit quality. But I also think it's an opportunity to look at stronger engagement, more inclusion of higher level or more senior individuals in the profession in that process. You look at the standard setting process. The SEC has talked about being more transparent being more willing to engage with market participants. I think that's an opportunity to me for some reform at the PCOB as well. And I think even in the inspection process, you look at the SEC when it was formed, you know, Joseph Kennedy was the first chair of the SEC, and he talked quite often about the SEC being a partnership with those in the regulated community who are acting in a fair and honest way. And those who aren't shouldn't feel like they're part of that partnership, but those who are have nothing to fear from the SEC. And I don't see that same message necessarily coming out of the audit regulator. I think a more symbiotic process where the regulator is actually looking for input on a more timely basis from the regulator, or in this case, from the auditor, in terms of how to improve its standards, in terms of inspection results that might provide a better indicator to the marketplace of the relative quality of the audit practices that we see today. I think audit quality has increased significantly from the PCOB's early days, but I don't think you get that message when you look at what we see coming out of the inspection results. So I think there's some opportunity for some transformation or change in how we regulate the public company space. We've seen tremendous growth in private capital over the last, decade or so. And we haven't seen that same type of growth capital happening in the public company space. I think individual investors really then lose out on a lot of earnings opportunity that is more concentrated in an accredited investor or an institutional investor space. And so I think looking at ways to encourage, and I think we talked a little earlier, Guy, just about the transaction volume increasing. And I think that helps our economy. It helps investors if they can engage in that growth as well. And it certainly provides a broader range of access to capital to companies who are looking to grow at an earlier stage.
Great points. A focus on reassessing disclosure requirements, a possible shift in oversight at the PCOB, and the rise of private capital and encouraging public market participation. As we look ahead, year 2 of the administration could be a turning point. Do you have any thoughts or expectations on what's ahead?
Yeah, I do think one will see, an SEC with a full team of leadership in place. So I think seeing then the follow-up on the activity that's commenced already, I think we'll certainly start to see a crypto landscape that hopefully provides for those who are operating in that space greater clarity. We should expect to see a focus more on materiality, whether that's in the rulemaking space. And I think that will come through end of year 1, year 2. The Division of Corporation Finance, I think having a leadership structure in place that provides oversight to the teams there, focusing them in the comment letter process, the IPO process, making sure that they're really focused on the items that are likely to be material to users. I think those are things we can look forward to. I do think on the enforcement front, that shift doesn't happen overnight, but you do have a leadership team in the SEC, certainly at the commissioner level. Chair Adkins, Commissioner Ueda, Commissioner Peirce, both existing commissioners have been there for a while, but we're also on the staff. Chair Adkins was a commissioner in the past, but also a staff member. So I think their ability to execute on their mission will certainly be improved by their longtime experience, both working together, but working as both staff and then former commissioners. I don't think it will be the case that it really takes that learning curve to learn the building and how to operate. They come in with really a head start. So I think we will see some real activity in the coming months.
That's great perspective. Jim, we have one last question for you, one that we ask all of our guests. What's the best piece of advice or the best question you've ever received, and how has it stayed with you?
So I've had the opportunity to receive a lot of advice over my career. One that has stuck with me was from Chris Cox, then chairman of the SEC. It was in the middle of the financial crisis, and it was along the lines of the importance of showing action during a crisis. If you think back to 2008, 2009, there was a lot of questioning of whether or not fair value accounting was contributing to a pro-cyclical effect in the market. And many in the accounting space, I think, were sort of suggesting that there was really nothing for accountants to do, that the crisis wasn't caused by accountants. And Chair Cox's advice to me was it's important to show action and leadership during a crisis. So even if you think that there's nothing to do, you should really examine, are we actually instilling confidence in the market? In that case, in the marketplace, translates to really any leadership crisis, right? Are you instilling confidence in those around you? Are you preventing confusion? Are you showing leadership and demonstrating accountability? And I think back even to that time where initial reaction, whether it was fair value or other aspects of accounting, was this crisis was about risk buildup and things wholly unrelated to accounting. If you took a look back, there was confusion in the marketplace about the role of accounting. What accounting marks should we be using? Is there something in the sort of the risk buildup and off-balance sheet accounting that was adding to the crisis? So that's a piece of advice that has long stuck with me, is when you're in a crisis, make sure that you're really taking action that's appropriate.
Great answer, Jim. The reminder to act decisively in times of uncertainty is a powerful takeaway for all of us in financial leadership roles. This has been such a rich and timely conversation. Your insights into the evolving regulatory landscape, the SEC's shifting priorities, and the future of financial reporting give us a lot to think about. Jim, thanks again for joining us, and thank you to our listeners for tuning in.
Thank you, Guy.
We'll continue to bring you conversations that help you navigate change with clarity and confidence. Until next time.
Thank you for joining us today on the Transformational CFO podcast, where we explore the evolving role of the CFO and the strategies for a successful path forward.
We look forward to having you join our next podcast as we continue the conversation with inspirational finance leaders.
The views expressed in this podcast do not necessarily reflect WilliamsMarston's views. It does not constitute accounting, tax, valuation, or other professional advice or services by Williams Marston, and it may not be relied upon for any purpose. This podcast may not be reproduced or republished in whole or in part without the express written consent of Williams Marston.